Okay, good morning, everybody, and welcome to today's open forum. We have some very special guests here today to talk to you guys about your tax and accounting items that you have, your planning, your tax planning, and everything else. I'll let them explain themselves. We have Marissa is here. Isaac is here from Formations. Guys, thank you very much. They're both senior account executives, both with a bunch of experience and specialize in real estate professionals. And I really appreciate you guys coming in. They have come highly recommended to me by a couple of you guys who have used them before, and they've done a great job for you. They're nationwide. All right, guys. Thank you very much, and welcome, Marissa and Isaac. You guys take the floor.
Thank you so much, Ryan. I love your energy. Good morning, everybody. So nice to meet you. Like he mentioned, I'm Marissa. I'm one of the senior account executives based out of Orlando, so not too far from some of you with Formations, and I'm joined by our most senior expert, Isaac Andreski. He's coming from Seattle, so got a little East Coast, little West Coast. Not trying to start a battle, but you get the best of both.
Exactly, Ryan.
Yeah.
Pretty fun.
Yeah, so I'm going to go ahead and share my screen. Give me just a second. And then while I do that, would love to know a little bit about y'all in the chat. So go ahead and put two things for me. First of all, I'd love to know where your business is structured, if it is. So if you have an LLC, a PA, a PLLC, if you have an S Corp, maybe you've done a C Corp, or you're a sole proprietorship, meaning you haven't done any of those specifically for your real estate business. Now, if you have rental properties, that's going to be different. So for you as a real estate professional in Florida, let me know what you've got. And then secondly, if you do have any questions about taxes, there is no stupid question. We would love to make sure you walk away from this feeling as confident and refreshed as possible, as much as somebody can be when it comes to taxes and accounting. So hopefully y'all survive a morning class talking about taxes, but I think you will. So yeah, let me go ahead and get this screen share going. And then Isaac, while I'm doing this, tell the group a little bit more about what we do.
Yeah, so for Formations here, our idea is there's a gap between what it is to be an employee of a company in 2023 and what it is to be self-employed in 2023. So our kind of roots come from the traditional world of accounting and tax. Our CEO had managed his own tax firm for nearly 2 decades and saw firsthand their corporate clients versus their high-earning real estate 1099 clients. And the sheer amount of extra work over taxation, just needless stress that falls on the 1099 people versus the ease and built-in systems of the W-2 people was striking. So our idea is build in the same support for bookkeeping, management, HR in a way, just benefits, consulting, and significant tax savings, as we'll see in this presentation, as a subscription model, and just kind of be that plug-in to help you all achieve financial freedom. Not a perfect fit for everybody, obviously, but we have a very strong playbook that we've seen work well.
Perfect. Thank you, Isaac. On that note, we're going to have a QR code at the bottom left-hand corner of the screen. If at any point you're like, actually, I think I just need to talk to an expert, or you know what, I did my taxes on my own last year, or my CPA did it, I don't really know if it was done correctly, I don't feel confident that I saved every penny I could, can someone just take a quick look and give me some feedback? Go ahead, scan that QR code. If not, Isaac can put in the chat our meeting link, and you can book a complimentary 15-minute session, and we can help you determine what tax strategies you can still do, if anything was maybe missing or done incorrectly from your last year taxes, and then what you could do about it before it's too late for 2023. I will say super quick, on average, these conversations save real estate professionals in Florida $18,000 a year, which is massive. If you own properties, I know that's obviously big with your brokerage, you actually could do something called cost segregation. On average, that saves an agent $60,000 on their taxes. So we're talking the big bucks here. So ultimately, we just want you to know what's available to you and be here to help if it makes sense for you. So let's get into it. The topic of our section is going to be never overpay on taxes again. Pro tips for realtors who want to save thousands on their tax bill with a stronger strategy and system. So a little bit about us. You may have seen us at NAR Next as guest speakers. You might have seen us with your association. In fact, a couple of agents in the group met us through their association, which is fantastic. Basically, what Isaac and I do is we work closely with Florida real estate professionals to give them personalized education and just give them a fresh perspective on cash flow management, profit first mindset, and reducing that tax bill. All things that are more important than ever right now, in my opinion. So the reality is that over 5 million full-time self-employed people overpaid on their taxes by over $100 billion last year. On average, you'll find that the real estate professional in Florida is overpaying just in one type of tax by about $11,000 a year. So I don't know about you, but if that's pocket change to you, give it to me. I've got an Amazon wish list for the holidays. We'll be happy to give you some things you can buy for me with 11 grand. But the reality is that any agent I talk to, they want that money for marketing. They want that money for a down payment on an investment property. They want that money for their family, their goals, whatever it may be. And so if you could do something today, like the couple of people I saw in the chat that could actually do a tax selection to save them, again, on average 11 grand, it is worth a second look. So essentially what we do is that we offload the behind the scenes admin work that comes with taxes, accounting, bookkeeping, financial guidance that a lot of agents really hate to do, especially the most successful agents. If you talk to an agent that's like top 50, head of the class, they don't want to do things behind the desk. They want to be talking to people, networking, getting leads, referrals, closing the deal. And so it's actually more profitable to have experts do those things like cash flow management, quarterlies, prepping and filing your taxes, S-corp management, than just dealing with it once a year during tax season and feeling like you're missing out. So essentially that's what we do. The reason why, again, is that there's just so many real estate agents that are missing out on at least 11 grand on their taxes. And like we talked about, the self-employed are always overpaying by billions as a collective on their tax bill. And out of all the personal tax returns we review, we can talk more about personal versus business return later in this presentation, but 80% were missing big things that they could do to lower that tax bill. So funny enough, we're actually doing a webinar today, later on. If you go to formationscorp.com, you can sign up. It's totally free. It's the 5 last minute strategies you could take advantage of for 2023. So we can help get you out of that 80% range if you're overpaying on your tax bill. We're going to talk a lot about something called an S-corp. If anybody here is an S-corp, please put it in the chat because we'd love to give you some pro tips. But an S-corp is a small business corporation, also known as a subchapter S. And basically, it's a way that you as a CEO of your business of one, can get all the benefits and tax savings of a corporation as well as the W-2 employees. Particularly, it saves you a lot in self-employment tax, which we're going to talk about here in a minute. Now, before we move on, you might be wondering, okay, like I'm a hot mess with my bookkeeping, or I've got a bookkeeper, I've got a CPA, but I have to still manage everything. So it's a time suck, or honestly, I just don't really understand what you guys do. So we are a hybrid between having a tech stack, which is designed for real estate agents, where you can see everything you need to on your laptop or your phone. So you can see what your tax liability is going to be, how much you've paid, what you owe for last year. You can see everything and anything you have to do for your business finances, such as renew your LLC with the state of Florida. In fact, we can just do it for you. You can see maybe if you have to run payroll as an S-corp. You can see every single expense, whether you have multiple credit cards in a business bank account or just one. Our team categorizes it for you. We help with commingling. We make sure that you're optimizing your write-offs to the fullest potential. Isaac will talk about why that's important here in a minute. You get P&L statements. So if you're looking to get a loan on a property, this is super helpful when you're self-employed. But ultimately, we have technology that gives you everything in one spot, managed by experts in real time. And we also give you education, guidance, and support throughout the year. So tax season is a breeze. Everything's been talked about. All your strategies are in place. It's just some quick paperwork to save you every penny possible. And again, the average savings is $18,000. $11,000 if you're just looking at self-employment tax, and I'll tell you how to get there in a minute. So if you like a good checklist, here's a snapshot of everything we do. For those of you that realized during the session, OMG, I should definitely be an S-corp, we can expedite all of that for you. So if you have a couple deals in your pipeline, you're expecting 2024 to be a successful year, or you have S-corp potential for 2023, if you're an existing S-corp, LLC, PA, or PLLC, we can rush everything for you, no problem. It's time sensitive, so we should definitely talk today or tomorrow, but we can and do that all the time. We make sure that you're in the right tax election. We automate everything we can for you throughout the year, give you ongoing tax management and insights, quarterly updates, prep and file your taxes. All right, let's get into the fun stuff. I want to talk a little bit about why it's important to have an LLC, a PA, or a PLLC in the state of Florida. Really quick, I see 2 S Corps in the group. Fantastic. Isaac, tell us a little bit why it's important to have an entity when you're a real estate professional, especially in Florida.
Separation, legally and financially. The direct benefit of an LLC or a PA or PLLC is you, as a human being, are legally and financially not responsible if you were to get sued or incur debt. Only the assets in the business are at stake. There is such a thing as piercing the corporate veil, but in general, they say it's the cheapest insurance you can buy for your business, just forming that LLC and getting that legal separation. In our opinion, the bigger difference maker is the financial separation. So, as a lot of you seem to know, with an LLC comes a business tax ID called an EIN. That's your employer identification number. It's tied to the business. You can use that to then open up a business checking account, which I can't express how many times over my 4 years working in taxes, consulting with self-employed, I've seen commingled expenses be the #1 hurdle to get over, the #1 reason why people can't understand net cash flow or just have a good cadence or rhythm to their tax strategy and just being able to take advantage of possibilities. So that separation, just devoting business to business with a formal business entity, is super key. So, of course, a lot of people do this as they're just starting off in real estate, which is awesome. But of course, if you once you start to grow into your role, and with more success in real estate, usually corresponds with more expenses, just paying for a lot more services and advertising and the sphere of influence things, then expenses ramp up, and then having a good accounting system becomes necessary. Devoting that accounting, whether it's QuickBooks or Formations, just good bookkeeping, so you can have visibility in your business financials with that separate business entity, is the kind of starting point really for running your business like a business. And then typically they say once you work with a CPA regardless if you don't like filing taxes or want to just look to see what's possible as far as tax strategy for you personally. There's a lot in the tax code that's aside from business strategy. But in general, if your net income, you're taking home more than 50K, then it's probably worth it to tag up with a tax professional for more than just once a year filing, because there's, again, just a ton available in the tax code as far as fringe benefits, write-offs, and unique tax elections to take advantage of. But the IRS isn't nudging you midway through the year saying, hey, congrats, Ryan, on the success this year. Did you know that you as an LLC holder can make an S Corp election, right? So it's good to just have a person to be in your corner to delegate the stuff to. So really it snowballs into a better scenario, but just having an LLC from the onset cannot hurt. At the very least, it would give you legal and financial separation, which is a huge perk, both tangibly, but also as far as mindset, just separating the business and treating it like a business.
Perfect. Thank you, Isaac. All right. So before we go into 2 big tax strategies, ultimately ways that agents are hit the hardest when they do their taxes, we're just going to quickly level set. Now, here's the thing. If this is too novice for anybody here, you can just let us know and we can breeze past it, but we will keep it fairly short. But basically, when we talk about tax strategy, we're talking about taxable income, also known as take-home money. So basically, when you get paid commissions, it's gross income. When you subtract your expenses and your write-offs, what's left behind is net income. That is what the IRS cares about. Now, if they compare your gross income to your net income in 1 year or a couple years span, it could put you at a risk of being audited if they don't understand the difference between the two. So they do care about gross income, but primarily you're going to be taxed on your net income, right? So as we talk about dollars and cents, just think about what your end result is, because that's what's going to be applicable. Now, there is I want to say old school mentality, or one mentality rather, of lowering your tax bill, and it's writing off as much as possible. If you're a newer agent and you're building your business, that makes sense, right? So you're going to need, you know, a laptop. You're going to need to start building up your marketing, your network. There's so much that you're going to have to spend money on. So in the first couple of years, it will make sense that your expenses probably outweigh your profits. But once you pass that, you know, newer agent level, the goal is that you have a profit first business. And so what does that mean? It means that at the end of the day, you have a net income that you're really happy with, right? That justifies all the work that you're doing and is why you got into the business. Unfortunately, if you're over expensing year over year as an established agent, you're not really getting all the benefits of your hard work, right? So it can be harder for you to justify your income if you're trying to get a loan for a property. It could be harder for you to sell the business because it looks like a lot of money is needed to keep the business afloat. And then at the end of the day, you might be stuck with a lot of gadgets and apps that you really don't need for the business to be successful. And wouldn't you rather spend that money on your personal goals, right? So we want to show you how you can expense appropriately and not miss out on anything. But we also want to make sure that you're not just leaning too heavily into write-offs, because at the end of the day, it could harm your business more than help. These are the categories that as a real estate professional, you can and should be writing off. Unfortunately, when we look at tax returns, we see these missed all of the time. If you want to go in depth, feel free to book some time with us. We can go into the specifics for your business, see maybe if you're missing anything and how to get it in before the year is up. But a couple that I want to underscore, and then Isaac would love to know what's important to you or what you see missed a lot. First of all, your mileage. I know it's annoying sometimes to have to track mileage. I totally get it. We recommend Mile IQ. I'll put it in the chat. We're not affiliated, but we've just seen really great results with them. And you can get a free version of the app. You just make sure it's running when you're traveling to and from any business destinations. And your brokerage is also a business destination. A lot of people consider it their office. And although there's office space at your brokerage you can use, it is not considered your home office. So you can definitely still track the mileage. On that note, we often see business use of home being missed. So there's two ways that you can factor in business use of home. You can either do a standard deduction. It's quick math that an accountant can do. This is pretty popular with CPAs that are just trying to get a return out the door. But if they do more in-depth of an assessment, you can actually write off a lot more for that business use of home space. So if you do have a dedicated area of your home that you're using for work,
Can't tell if it's me or Marissa.
It's not you. It's
Marissa.
Marissa. I thought it was me too. Okay.
I can.
There she is. Marissa, we just lost whatever you said there.
Oh no, probably a good thing.
Go back 15 seconds.
Basically, yeah, can you hear me now?
It was detailed business use of home that you were talking about.
Yeah, so definitely take advantage of business use of home and any expenses that come with it. Second part is going to be your cell phone bill. So you could do cell phones one of two ways. Either you can do a percentage that you use for business. So if 80% of your cell phone use is used for work, write that off. The other thing you could do is you could just get a cell phone only for work. It's really a personal decision, doesn't impact your taxes significantly, but make sure you're writing that off. Isaac, what are some expenses that you get a lot of questions on or you find are missed opportunities pretty frequently?
Yeah, I think you nailed the commonly missed ones: mileage, just anything in an accountable plan, home office, insurance, whatever. I can't think of any other common missed opportunities aside from that, but there is something you mentioned as far as over-expensing, and I think it's important to stress that the kind of guideline for expenses are two words: ordinary and necessary. If you're paying for something that has a direct or even indirect impact on your business, then it perhaps should be considered as an expense. But over-expensing is, to Marissa's point, not the best way to say it. There's a lot to lean into and take advantage of in the tax code. Plus, over-expensing is, of course, the number one reason for audits. The IRS, for the past decade, I think, has had a DIF score system, a discriminant function system, where everybody's 1040 gets scanned, yours and mine, and it looks for averages and ratios. So if the average staging costs for a real estate agent in Florida is 10% of gross expenses, and I'm writing off 50% of staging costs as my gross expenses, then the IRS computer system will move me into a potential audit category. So a lot of people look for additional expenses to just throw into their tax return to reduce their income to the smallest amount. We of course want to be mindful of everything that's possible, and so does the IRS. But in general, overexpensing is not the way to go. Having a good accounting system to track in real time and just make sure everything is punctual and actually, categorized appropriately is the way to go. But no need to, venture into gray areas, especially if you're trying to reduce the risk of audits, right? But no, I think Marissa, you nailed it as far as the common missed expenses. So now we're going to get into the tax part. So this is where we like to get into numbers, and we're going to use an example of a real estate agent whose net income is $150K. And I think it's important to kind of start with some context and just kind of lay out that there's more than one type of tax that we all pay as active income earning Americans. We're going to focus on federal and FICA tax for self-employed. In the group chat, it's known as the self-employment tax. But these are very different types of taxes, different percentages. So we'll get into that and show exactly how you can save tax within these two types of taxes. Starting with federal, this is probably a refresher for a lot of people. Federal income taxes pay for most of everything in the American system: defense budget, highways, infrastructure, school, whatever. It's a progressive tax, meaning that the percentages progressively get higher and higher and higher and higher and higher the more that you earn. And it's a big topic of political discussion for many reasons, but everybody should know that when it comes to tax savings, it should start with understanding your highest marginal tax rate. That is the highest percentage that you hit on the federal tax chart, which I believe the next slide will show. This shows a 2023 single filer. So a lot of people assume, and myself included before I got into taxes, that if I earn 150K and I'm reporting 150 as my taxable income, since that falls between kind of the middle row there, the 95 and the 182 number, then the government's taken 24% of my 150K hard-earned commissions. What the heck? Well, not quite the case. The way the progressive system works is the first dollar that I earn up to $11,000 as a single filer is taxed and fixed at 10%. And then if I make $1 over 11K, from 11,001 to 44,725, that then moves up a rung, and that stretch of income is taxed and fixed at 12. So that's the progressive system. And so just understanding your net cash flow with good bookkeeping, with business separation at this point in the year, midway through the year, tax season, you can kind of take a look at where things stand and say, okay, my marginal rate, my highest percentage, if I'm making 150, is 24%. Every dollar I earn over 95K roughly is taxed at 24 cents on the dollar. So then the conversation with your tax professional becomes, all right, what can I do to offset this? How can I shave off the top, so to speak? And so let's look at a couple examples of what's possible. But first, let's provide some proper framing, because we do believe we've talked a lot about expenses, some commonly missed ones, and surprise, surprise, the biggest missed expense, which isn't actually an expense because you can't unsubscribe to the IRS. But if you really think about it, what's a fixed cost in your business that you can't avoid that is by far the lion's share? It's your tax bill. A lot of people view taxes, and understandably so, as kind of just a one fell swoop haymaker punch that hits you come March or April of the following year. But really, if you break it down, it's a huge monthly expense. If your net income is 150K and I'm falling into that 24% marginal tax rate, then if the IRS just had me pay monthly distributions for my tax payments, then I'd be paying $2,500 roughly on a monthly basis. And that's more than any staging cost that I've ever heard from talking to agents, aside from one person here in Seattle who paid $6,000 to $10,000 on a monthly basis for staging, circumstantially. But that's a huge monthly payment. So with this framework, what can we do to apply a discount code, so to speak, to our monthly IRS federal tax bill? There are really a couple common ways: expenses, fringe benefits, and retirement. So with expenses, we kind of cover this. There's always kind of a balance of how much do you want to expense, how much is ordinary and necessary to expense. Does the standard deduction outweigh your Schedule A itemized expenses? But in general, with those things missed that are commonly missed, and typically we find our tax team finds that the average agent misses between 2 to 3 grand of possible expenses, which if you add 2 to 3 grand in expenses to your tax bill, or sorry, to your tax form and write-offs at the 150K rate, you're saving 24 cents on the dollar, which is fairly significant. But in this example on the left, it shows somebody who went from the standard deduction, just kind of the default subtraction number that the IRS gives you, to actual robust accounting and deducting close to 20% of their GCI, which is average that we find for agents. So adding an additional 10 grand in expenses at the 24% tax rate saves you 24 cents on the dollar. To the tune of 10 grand, boom, you save yourself $2,400. Look at the retirement, the bubble on the right. Meredith Publishing found from their 2019 study that less than a third of full-time self-employed contribute any money to retirement. No duh, you don't have an HR department, you're not auto-enrolling in 401k like perhaps you used to. So you gotta seek out these plans yourself. So having the right guidance and support can help really move the needle. And what we're big fans of are kind of the mid-tier plans, the SEP IRA and the 401k, where the max contribution is $60,000 of contribution pre-tax per year. Of course, it's closer to like 20-25% of your net. But anyways, this shows an example of somebody who went from a traditional IRA, kind of a starter pre-tax plan, to a SEP or a 401k, where they save nearly 5 grand in their tax bill, and that money invests over time, building compounding interest. It's a win-win in most cases. So we really, just to sum it up, don't mean to bore you with numbers, but by building that framework, getting the LLC, the accounting, and that visibility and separation, you can start to lean into more benefits, more strategic write-offs, and just attack the federal tax rates with, I mean to say attack, I meant to say get strategic around how much you can offset as far as your highest marginal tax rate. You know, attack it. Let's go. It's early here in Seattle. I'm ready. I'm fired up. But that's federal taxes. So again, if you want to take a look at or have one of our tax professionals take a look at a previous year's 1040 to kind of give an assessment of what's possible, what might be missing, we do offer those complimentary tax reviews, and feel free to schedule a meeting in the link that we provided earlier.
Perfect.
Cool.
Thank you, Isaac.
Pass it back to you. Yep.
Awesome. Cool. I'm going to pause here for a second. We're just going to have about maybe 10 or 15 minutes more of dialogue. We're going to talk about one more big tax strategy and dive in a little bit more into retirement, since that's super popular. But any questions out there? Anyone want to chime in with anything they want to share? I saw a good question in the chat, so we're going to go through that here in a second.
Yeah, that was going to be my question, because you guys talked about getting the money. Obviously, we have to get the money from the LLC to the power bill, you know. So how do we do that? And I guess that's what Tammy's asking there with how do you pay yourself from the LLC? So that was going to be my question, because that's one I hear a lot.
Yeah, I love that question. Let's go into it. So the next type of tax we're going to talk about is self-employment tax. Isaac mentioned this earlier. It's also referred to as FICA, but essentially what it is it's Social Security and Medicare. When you are a W-2 employee of a corporation that's not your own, you pay 50% and your employer pays 50%. And so it can be very hard and shocking when someone goes from being a W-2 employee of another corporation to being fully self-employed, because now they're paying 100% of what's expected by the IRS into Social Security and Medicare. And here's the thing. It's not that we're saying don't pay into Social Security and Medicare, because that can help you in the future, of course. It's that you're overpaying, right? And so when you're self-employed, you pay self-employment tax to cover it. It is 15.3% of your taxable income. And so regardless of what state you're in, you have to pay this tax. So through Isaac's tax strategy a couple minutes ago, he was able to lower the net income of that 150K agent by $30,000. So we're going to continue to use that agent. Now their taxable income is 120K. If you look at self-employment as a monthly subscription, like Isaac mentioned before, in this one type of tax for an agent making 120K, they would be paying over $1,500 a month. That's 18 grand a year. I don't know about you, but having to shell out $18,000 today towards taxes would definitely stress me out. So there's a way around it. So what you do is, again, you become an S Corp, a small business corporation. It is a tax election on top of an LLC, a PA or a PLLC when you're a real estate professional in Florida. As an LLC on its own, you do not save on taxes. You've got to take advantage of tax strategies, including the S Corp tax election. So there's some good news and some bad news with that when you're looking at the end of the year like we're in right now. The good news is that a couple of you put in the chat that you already have the entity. If you don't have an LLC, please book some time with me and Isaac. If you just take one more step that we can do with you, you can take advantage of saving every penny possible in self-employment tax for all of 2023 so far. So if you've made $60K this year in taxable income, it could save you $5,000. So pretty impressive. It's not too late, but it is urgent because we're at the end of the year. So please let us know if that's applicable to you. The not great side is that if you're a sole proprietor, meaning you don't have an entity right now, you're going to get hit with this big tax for 2023. There's no way around it. But what you can do is you can explore other ways to lower that tax bill, and you can get ready so you don't have to overpay in this way again for 2024. So how does it work? You've got your gross income, you subtract your expenses, your taxable income. Traditionally, if you're not an S Corp, you're paying 15.3% on 18K. But when you become an S Corp, you are now seen as two different entities with the IRS. One is going to be the corporation, right? That is attached to the LLC, PA, or PLLC. The second is going to be you as the W-2 employee of the business. And so now the IRS understands that you are doing the work of two people. You're the CEO running the business, and you're doing W-2 work for the business. Typically, and this kind of goes to the question in the chat, and what Ryan elaborated on, is that you do have to pay yourself a W-2 salary, just like any corporation paying its employees. That is called a reasonable salary or reasonable compensation in the eyes of the IRS. It has to be fair, so you can't just pay yourself $1 and only pay self-employment tax on that. But you also don't want to pay yourself too much, because you can still pull from your business profits, just like you do today, to spend it on whatever you want to spend it on. And so this is generally between 30 and 60% of your net income. We do a study, which helps us determine a range that makes sense for your business, and then we help you determine what's the most advantageous. So instead of paying 15.3% on 120K, you're only paying that self-employment tax on the salary that you pay yourself through payroll, which you typically run on a monthly or a quarterly basis. So 15.3% of 48K is going to be a little over $7,300. So the difference between what this person would have paid not being an S Corp versus what they are paying in self-employment tax is that $11,000. That is big. When we talk about tax strategy, we talk about the here and now and big picture, right? And so for an agent that goes S Corp and they maintain their net income in the 120 range, in a 5-year span, they would save $55,000 in one type of tax. That is amazing. So even if you're like, I'm not sure if I can do it for 2023, or I don't know if next year is going to be a great year, are you still going to be in real estate for 5 years? If the answer is yes, absolutely go S Corp. Absolutely, or at least take a second look at it. So do you still get taxed by the IRS on your business profits? Isaac, I'm so glad you're answering that. Thank you. To elaborate on what he's saying in the chat, yes, you will still pay tax on your business profits. As an S Corp, you're not exposed to something called double taxation, meaning your distributions get taxed and then it gets taxed again as a big picture income. That's something that C Corps are applicable to. As an S Corp, you don't pay double tax on this or really anything. What this is doing, the S Corp, is it's shielding you from paying self-employment tax on the business profits. And then we're going to talk about retirement here in a second, but just to elaborate, the payroll is awesome, right? You run it, again, quarterly or monthly. You can write off your healthcare premium through the W-2. You can do a solo 401k that you as the employer can match, which is a write-off. So that's a great tax strategy. You could do an HSA, an FSA. You can use an HSA for your family. It doesn't just have to be for you. There's so much that you can do by running that payroll. But also, I don't know about you, but a lot of agents get hit with penalties because they don't pay quarterlies. So by running payroll, you can also have your federal and state taxes pulled out of that payroll, just like if you were W-2, and go directly to the IRS. So that's a really good way to avoid penalties, saving you more money, and then helping with cash flow management. So the big benefit, of course, is self-employment tax savings. However, there's a lot of cool things that come with running payroll. If you're curious to know what the savings look like on a monthly basis, if you're making $60K net, you're looking at least $450 worth of self-employment tax savings. 120K, we talked about it, but you're looking at 900. And then here's some numbers for above that. And here's a quick recap of what we covered. So at the end of the day, you want to make sure that you're paying an appropriate amount of federal tax, not a penny more. You're preventing yourself from overpaying in self-employment tax, and you're not wasting time that you could be spending on building profits on doing busy work behind the scenes and then ultimately rushing to do your taxes, which is one of the biggest reasons why people overpay on taxes in the first place. Isaac, I would love for you to take us quickly through benefits and retirement. And while he's doing that, if there's any remaining questions, feel free to go ahead and put them in the chat. I can also add some education content. And then if you'd like to chat with us, a way to connect.
Yeah, of course. So when it comes to retirement, I don't know, everybody knows retirement's beneficial or might not be the right plan for them if they have other investment strategy. But I like this guy, Scott Galloway, who's a Floridian, has a couple podcasts. He has an example of if he had this idea where if the U.S. government gave every newborn child $6,000 when they were born and put it into a safe account, for investment's sake, that grew at a 10% rate year over year until they're 65, then every American would have $1 million plus by the time they retire. So there's a power in compounding interest, depending on where you're at, how many years you have until you retire, what your financial freedom number is. There's a different plan and scenario for everybody. But in general, there are three sort of tiers that we like to advise on. The first tier isn't shown here, but a traditional IRA is a great starting point. It's pre-tax, $6,000 max contribution, or $6,600 this year, I think. Same with a Roth, that's after tax. So you contribute to it in addition to your pre-tax plan. But when you take it out, when you retire, it's tax-free. You don't write it off this year, those contributions to the Roth. It's still beneficial, right? So that's kind of like the starting point. That's what a lot of people like to do, and if they're just starting off in retirement. But if your net income is over 100, 200K, then the SEP IRA, 401K are just very strong plans where close to 20, 25% of your net income is what you can contribute. If you're an S Corp, the solo 401K, it gives you more bang for your buck in general, which happy to get into that if you want to schedule a free consult. And if you're making over 300-400 grand consistently, top earner, then a defined benefits plan can help you save on average, well, in our case, over 30 grand in pre-tax contribution tax savings current year. So it's like 401k on steroids. And again, happy to get into it if you want to schedule a free consultation with someone from our team. But those are the recommended plans. Again, there's no one size fits all, but it's always worth considering because there's a lot available and it's a good way to secure your future. And yeah, love this example. So this shows an example of somebody's making 80K and what they can possibly save just by taking these steps. So starting off with the self-employment tax, the far left bubble, with the reasonable salary, this example assumes a 40% reasonable salary. They're saving about $6.5 grand just in self-employment tax. And then the two bubbles to the right show federal tax savings. Adopting benefits, I believe in this example, we assume this person was single, hadn't contributed to HSA, so they contributed to a health savings account, deducted life insurance premiums, just had some other fringe benefits adopted. And again, at 24 cents on the dollar, you're saving 22 cents on every dollar you write off or are able to offset on your taxes based on those contributions. So that totaling is an amount of $12,623. I believe this is a case study from one of our clients from 2021. I don't know their name, but just shows an example of what's possible, even if your net income isn't 100K plus. If you're making 80K, it's still possibly a good time or a good position to be in to take this step with the S Corp and additional benefits.
I think that wraps it up.
All right.
Yeah. And last but not least, it does put you at a significantly lesser risk of being audited. When you are an S Corp, you're in a pond with a lot of big fish, Amazon, Google, Target, all the big dogs, Publix. And so you are significantly less likely to be audited because That department is looking at the big corporations. When you're a successful real estate professional and you're a sole proprietor or just an LLC, you are the big fish in that pond. So getting into a corporation definitely benefits you on this perspective too. And just by being an S Corp, you've got a lot more structure in place. So you are certainly prepared for an audit if that should ever happen. How much does it cost to open an S Corp? It depends. It is something that a lot of CPAs and accountants overcharge on. We are not a fan of that. We do all the work for you, so we could talk about how much we charge to do it. I would say that it's really important to get it done quickly and done correctly. And Florida, as we all know, has a lot of particular things you have to do when filing your corporation, such as your name on your entity has to match your name on your license. So we know all the nuances and we can certainly help with that. I did see that SunBiz is an option. Yes, that is how to get your entity, but it's not the full S Corp formation and management, but SunBiz is a good place to start. So you could definitely do that.
You had a couple of questions before that on there.
Yeah, FICA is 15.3%. Love that question. Thank you. And then if you make under 50K a year, is it still a good option? It can be, but it depends. It depends on where you see yourself going for 2024 and 2025. If you think you're going to maintain 50K net, you could do it, but your tax savings in self-employment tax alone will be small. But you can still take advantage of the other tax strategies we talked about and so much more. So ultimately, you can make it a beneficial move. 60K is typically where it's like a clear as day, absolutely great move.
Okay. So with the LLCs and stuff, and these are questions, guys, I get all the time, and I tell them to contact a tax professional. A lot of people in this chat have asked me about these things. Should I do an LLC? One of the things I do want to reiterate is what you just said, because this happens all the time. Somebody will open up an LLC called, Happy Sunshine LLC.
Yes.
Instead of their license name. It has to be your license name. The state will not give you that. We cannot pay anything but your license name. So your name needs to be, Marissa Lamperis LLC. It can't be, whatever you want. So another question that I get all the time: can I write off all these things through my LLC? Do I pay for my car and my cell phone and my mortgage and my this and that? And so I tell them it depends, but you guys, talk to a tax professional. Maybe you guys can kind of hit on that real quickly.
Yeah. Listen, guys, listen to Ryan. He already knows. It really does depend, because here's the thing. We can look at isolated tax strategies, but it's really part of the big picture, right? So sometimes if you're doing one tax strategy heavily, it's going to impact other methods you're going to take. So when it comes to expensing your, let's say, cell phone out of the business, if you're using that business 100% or that phone 100% for business, you can use it with your business credit card to pay for it, no problem. If you're using it for personal and business, that's a formal write-off that you can take during tax season. So it really just depends on how you're approaching that. With the vehicle, if you do have the vehicle under your business and you are writing off the expenses, you cannot do mileage. And if you buy the vehicle under the business, you can actually never do mileage with that vehicle because you've already gotten significant tax savings from it. So that's why it's good to have professionals in your pocket, like as you make these moves, which, by the way, it would be a good move to buy a vehicle for the business. If you're going to do it for 2023, I would definitely do it this week. Don't ask me where to go. Where I bought my car, I did not love the experience. So, so if you guys have recommendations, let me know. But anyways, now is a really good time to make moves like that. But it is part of like the bigger picture of how your tax strategy is. So.
Awesome. Any other questions? Any other questions for these guys? So if they already have an LLC and they want to make it an S Corp, contact you for that?
100%. And if you don't have an LLC, that's okay. We can help you as well. We charge what SunBiz charges, and we even expedite it for you. So I would be happy to do that. No problem. So very good. Ryan, thank you for being such a great collaborator. Thank you so much to everybody. This has been such a great group. Andre, thank you so much for doing the introduction. We're so happy that we were able to be part of this. And you survived talking about taxes for like 45 minutes. So that's big. Put that on your resume, your LinkedIn. Should be a certification. But thank you all so much. Isaac, did you have anything you want to add?
Closing remarks. No, enjoy the sunshine. It's a sunny day here in Seattle. We get one of these during the winter months, so I'm about to go on a nice walk. And yeah, thank you all again for having us. And till next time.
Great. Thank you, guys. And Marissa, you left a thing, how to reach you the best way. I know there's QR code, but did you leave something else?
Yeah, Isaac put the link in the chat.
Okay.
And then we got so you guys should be good to go. So.
All right, guys. All right. Well, thank you very much, guys. Thank you so much for coming in. You guys were awesome. Happy to have you guys here. Anything that helps the agents. I get so many questions on this kind of stuff, and I always tell them to talk to a professional. So it's good to have you guys in. And guys, reach out, contact them. I know Andres, Lisa, maybe some others of you have used them, and you know, I quoted Andres in the invitation to this thing about how much he's enjoyed working with you guys. Peace of mind to give him, knowing he's doing the best that he can. One question from Daniel before you guys go.
Perfect.
Yeah, like me, I'm in Social Security. Do I have a limit of money I could make on real estate that I don't have to be penalized by the IRS?
Social Security. He's on Social Security.
Yeah, so even if you're collecting Social Security, when you get paid, you still have to pay back into Social Security. Your contribution will taper out just a little bit after about 160K net income, but you still have to contribute. So you can still go S Corp even if you are collecting Social Security.
Okay, so I could go up to 160 and don't have to be penalized by them, or you saying?
No, it's the first, anything you make between, you know, $1 and 160K, that's going to be, you're going to get hit the hardest by self-employment tax. After about 160K is where it softens a little bit, but it's still there. You're still going to be paying into it. So you can't completely avoid being, you know, taxed by the IRS. And that's why it's good to have people in your corner that can help you pay as little as possible.
Oh, okay. All right. Thank you.
All right, we had another question from Victoria in the chat. I'll go ahead and answer that. Yes, they did answer that. 50K, and you guys can correct me if I'm wrong, is about the break-even point maybe of this.
Yeah.
So if you see yourself doing more than 50K in the future, then it would be a good idea to get involved in it. And if you don't, then you're probably on the fence.
Ryan, start doing classes with us. That was perfectly said.
Great. Yeah. So any other questions before they go? All right, guys. Well, thank you very much. Really appreciate you guys coming in. I learned a lot. Hopefully everyone else did too. And definitely you'll have some people reaching out to you because they're asking for information. All right, guys.
Sounds good.
Happy holidays.
Thank you so
Happy
much.
holidays. Take care. Bye.
Happy holidays, you guys. Thank you. All right, guys. Open forum. Anything you guys want to talk about real estate related? Hopefully you guys enjoyed that. Hopefully you got something out of that. And I really appreciate, again, Andres and Lisa. Guys, I have people come in and talk to you guys if I think it can help you. And you don't have to use the companies that I bring in for stuff, just like the Reminder Media and the other things that I have people come in and do. But I'm just letting you guys know what's out there for you, for your, in this case, your peace of mind. And I know I have an accounting person who, I don't know that they specialize in real estate as much as they should. And I'm, you know, I'm going to look into this as well. So yeah, Tammy.
Okay. So I'm getting a listing and they have bed bugs. So I'll say this disclaimer and then I wanted people's opinion or if anybody's dealt with this. So basically, if the seller doesn't do the top treatment, which is probably 10th the house, which is $3,000, I don't know that I really want to take the listing because I wouldn't feel comfortable that the other two options completely get rid of the bed bugs. So my other thought was if he balked at doing the top tier treatment, I would be willing to contribute some of my commission because I'd rather have some commission as opposed to no commission. So I'm just kind of putting that out there. Has anybody dealt with bed bugs? And it's got furniture in there. It's kind of a big deal, but anyway, that's what my question is today.
Okay. Do not listen to Angie who says to refer to an agent you don't like. So what we're going to do is disclose. Have they balked at the tent?
No. So I got a referral and I called one guy and it was like an individual and it was $750. So I called Massey. It's $3,000 a tent. I just briefly looked at the quote. I just got it this morning. I think it's like $1,900 to do the 65-day guarantee, which is like heat and spray. And then the one below that isn't really much less, which is like a spray only. But they only guarantee like for 45 days and 65 days for the two lower treatments. Tenting is like 100% guaranteed. Bed bugs can get in the light switches, can get,
Okay, yeah. So we need to do the tenting, but we need to disclose. There's no reason not to take the listing. It's just like any other defect to the house. It's something somebody else is going to have to spend $3,000 on.
yeah, but I'm creeped out to walk in the house. If you can, bed bugs are so like contagious that I wouldn't want to expose anybody to showing the house or an inspection.
Okay, well, let the sellers know this. And if they won't, maybe offer to pay for it up front for them, out of your commission or something like that, where they owe you if it doesn't sell or whatever, they pull it off the market, they still owe you, but put it in your listing agreement. Or something like, if they balk at them spending the money, but they shouldn't, because you're going to tell them, look, nobody's going to come look at this house. I have to disclose it has bed bugs. Bed bugs get on your clothes if you walk through the house and you take them back to your house. So nobody's going to want to come look at this house, even much less buy it.
Right.
So that's what I would sell them on.
Well, I already told him he's like, well, can I get the furniture out and then do it? I'm like, well, that's up to you. I said, but ethically, I do not think that's right because you're contaminating any,
Well, it doesn't, but the furniture doesn't matter. It's in the carpets and everything else.
It's everything. It's in furniture. It's everywhere.
If anything, you'd want your furniture to stay in there while you do it.
Exactly.
Okay. Well, I think there's your answer.
Okay.
You just have to do some salesmanship on them, Tammy, and get them to tent the house, regardless of what it. I mean, are you saying they don't have $3,000?
No. It's an estate. And he's got a credit card and he can pay for it.
Oh, beautiful.
But if he balked, I was just going to offer to contribute.
Okay. Well, I'll tell you what, I'm taking way more than $3,000 off any offer on a bed bug house that I'm looking at. I don't know about everybody else here.
Yeah.
But bed bugs, it sounds a lot worse than $3,000. So if $3,000 can handle it, he's better off doing it now, because it's going to take, people are going to take a lot more than that off the offer that they make.
And it might sit there, it might not even sell.
Because now I got to put a tent on it. And I got to do all that stuff. It's inconvenient and it's everything else, but they're not using the house right now because it's in an estate, right? It's a vacant.
Right.
Oh yeah, bomb it with all the stuff in it. Yeah. So I think it's a no-brainer.
Okay.
I mean,
So you're basically saying if he didn't want to do the tenting, then you, in my position, you would offer just to pay for it and be reimbursed at closing,
yeah,
or
but
take it out of my
if it was a money
out of my commission.
if it was a coming out of pocket issue, I assume that's what it was. Why somebody wouldn't do that is because they didn't want to spend the money, because you were like, it's a $3,000 thing. I think it's a no-brainer.
Hopefully he does too.
Hopefully he does too. If he doesn't, let me know.
Okay.
All right. I can even talk to him if you want. I don't, if he doesn't, for whatever, doesn't believe you or whatever, I can tell him.
Okay.
Because especially it's an estate property, meaning it's a vacant property, nobody's living in. It's a perfect time to do it, perfect way to do it, and you do not want to sell it like that.
That's the right way to do it.
Well, people are gonna run from it.
Exactly.
All right, Miss Valerie.
Yes, I'm just kind of curious, Tammy, in that situation with that house, if he did agree to tent the house, when do you cut off the disclosure? Does she still have to disclose? Since you were talking about 45 days and 65 days, as a realtor, is she still required to disclose that they had a bed bug problem, but the house was tented?
The tenting does do 100%, but I still feel like you have to disclose.
No, you want to. So here's the thing about it. It's a great question, Valerie, because here's the thing about it. If that house goes under a tent, just think about your neighborhood. If somebody in your neighborhood went under a tent, what are you thinking?
Okay.
Termites.
Yep, termites. You're much better off to disclose bed bugs. It's been treated. Here's the guarantee forever that they're completely gone. Attach it on the MLS. Everything, just say it had bed bugs. They're gone now. And here's the attachment.
And they'll get a bond too. They get a bond.
Yeah, and they get a bond. Perfect. Yes, but you absolutely want to say that, because otherwise they're going to come out and look at it, or they're going to buy it, and the neighbor's going to say, wow, you get rid of those termites? And they're going to say, what?
Okay.
So So
said it.
anytime things can be, that's why I like to disclose stuff. Anytime, what do people always assume? The worst, right? If you don't tell them, it's the worst.
Yeah.
I did something last night, but I can't tell you guys what it was. You start thinking of something terrible, right? So
Okay, who did you murder? Where you bury the body? Okay.
that's right. That's right. So no, you definitely want to disclose that one. Great question. Any other questions, comments? Did you guys see the okay, Andres, hold on one second. Did you guys see the holiday party invite? If you can make it, it's at our corporate office in Orlando. Sign up for the potluck if you want to. Sign up for the White Elephant gift exchange if you'd like to. But it's just a holiday party for everybody, including you guys. Andres. Andres, I think you're on mute. I think your head's moving. There you go. You're still muted, Andres. The icon's at the bottom left one is the microphone. Okay. All right. We'll move on and come back to him. Any other questions? In the meantime, guys, let me get to this first. So you guys are going to, rates are starting to come down. Guys, this market is about to take off when the rates come back down. Assuming the rates come back down, the market is going to take off. Make sure you're getting out there, getting your branding out there. I feel like this market is about to take off. This is just me. So I do not guarantee this, but I do feel like this market's about to take off. Rates are back down. You're seeing stuff in the 6s soon and stuff like that. So this thing gets down in the 5s. I think it's really going to take off. Valerie, we'll let you go again, unless Andres is ready. Andres, are you ready? No. Okay. Maybe his microphone's not working. Valerie.
Yes, I did come to the meeting late, so I don't know if you touched on it or not. But when you said rates are going down, I was just wondering about the blowback that we as realtors may get as a result of the NAR, that $1.8 billion verdict or something. I mean, should we anticipate or be prepared to talk to people, sellers, about that?
I'm glad you asked that, because even though we talked about this a lot in the last couple of months in these meetings, but I had some more people this week talk about this. Someone got blowback at a listing. They already had a listing agreement, and the sellers came to them and said, why are we paying they got a net sheet. So they already had a listing agreement that had 2.5. Then they got a net sheet and they said, well, wait, why are we paying the other side? Like, they didn't understand the listing agreement. For now, the listing agreement still says, and so it's not official yet, or they would have given us a new FAR listing agreement. Listing agreement as of yesterday afternoon still says, if you don't offer commission, we can't put it on the MLS. So you do still have to offer commission. Now, the only change is in the future, assuming this law, which is still in appeals and everything else. So I don't know how long this is going to go on. They just started another case in Florida and named a bunch of brokerages, a smaller case where they named a bunch of Florida brokerages as well. This is just a money grab by lawyers, and it is the best thing for business is the way that we've been doing it. I have no doubt about that. And there's a million reasons, we've gone through them all before, but well, not a million. There's about 5 reasons, and we've gone through them all before. But for now, you still have to offer $1. So there's no difference, pretty much, as to what you've been able to offer before. It's always been the seller's option to just offer $1. So I don't know. It's a $1 difference. Now you can offer 0. So we've talked about using buyer brokerage agreement. We've talked about all kinds of stuff over the last couple of months, Valerie. But it shouldn't make much difference. You explain to them, look, this is how many people are going to see it if we don't offer any commission, and we're going to have a lot more people see it if we offer them 2.5%, 3%.
Okay.
And that's just the bottom line. It's do you want more people looking at your house is going to get you more offers, better offers. No, I don't think so. Angie, can you put 0 on the MLS now? I don't think so. The listing agreement says you can't. So until they give us a new listing agreement, I don't believe you can. You can try it just for fun. Try editing one of your listings right now and see if it works, and then edit it back. But I don't know if you can, or if their computer program will let you or not. Probably not. because the listing, they haven't given us a new listing agreement, guys. It would take them, last one was updated in May 2020. It'll take them 2 seconds well, not 2 seconds. It'll take them 2 days to get us a new one, just because all they have to do is take out line 163 or whatever that is. It's on its own line. They could delete it in 2 seconds and get it out there to us, but they have not done that. Any other, because that's the only change they would have to make on the listing agreement. And you guys all know the line that I'm talking about, where it says if 0, then you can't. If none of these are checked, then you can't put it on the MLS. All right, let's go. I think Andres put his question in the chat. Okay. Have a listening date to an elderly couple with medical issues. They are selling and moving into an RV. Need to get rid of furniture and clutter, but they want to sell everything. Lots of wear and tear stuff, not much value. Is there a service that can go in and help with this? I'm sure you can get people to take stuff to the dump.
Hunk's hauling junk, 1-800-JUNK.
Yeah, there are some things like that. I would Google that, Andres, but there are some people. Otherwise, it's just movers who take it to the dump for you. But I think there are junk.
Salvation Army.
Yeah, you can try the Salvation Army and stuff like that as well. That'll be free. But I don't know if they may want to look at the stuff before they send a truck out there to get it. Because you never know if something has bed bugs either. That's true. Any other questions? Malvis demanding that someone bring her a buyer for her listing at Bridgewater Subdivision 32828, close to Waterford Lakes, great schools, 737 Bridgeway Boulevard. Bring Malvis a buyer. No, please or thank you. Oh, there it is. Please, Malvis says, please. I'm just picking on you, Malvis. All right, I like it though. That's aggressive. I felt like I had to do it.
Yeah.
So she's not asking you; she's telling you. Anybody else have anything? Guys, I hope you got something out of the, did you guys get out of, I can only see about 4 of your heads, but did anybody get anything out of this, the accountant people? Hopefully you guys got some kind of idea of what you need to do. I know it costs me money every year not being better prepared. And I know a lot of you are in the same boat because you asked me a lot of the same questions that I have. And I tell you to talk to a tax professional, just like I'm programmed to do. Just like a lot of times you guys ask me legal questions, and I say, you better get that from a lawyer because I don't want my name on it. But here's what I think, but talk to a lawyer. Because you guys know, if you learned from someone, one of your elders one time has told you anything before the but doesn't count. So always say, here's what I think, but you should talk to an attorney. Because I'm not a legal professional, I'm not a tax professional. So do that. Talk to them. All right, guys. If there's no other questions, we're going to go. Have a great week. Next week is the 20th. We'll have another one on the 20th. We will not have one between Christmas and New Year's on the 27th, but we will have one on the 20th. So I'll see you guys next week. And Amazon for generic open house signs. Yes, you can do generic open house signs. You can also get them from, we have open house signs, guys, if you want to borrow them for the weekend. Just contact Michaela. And you can get those done there. You can get generic ones on Amazon. You can get any made that you want to make, you want to have made, that you need to have the brokerage name on them. So be careful with the generic ones. If it has other ones that are obvious, that have our brokerage name on them, you need to use those. Otherwise, you look like you're not a realtor, and that is not legal, not compliant. All right, guys, take care. Have a good week. I will see you next week. Christina says, please bring me a qualified buyer. Junk removal provider. You're getting some answers. Now everybody's contributing, getting some answers. Junk removal providers. All right. Thank you, guys.